So we have seen what is the case with the gross profit margin. What they are saying is, so like gross profit margin is however is considerably lower than in the previous year. Excuse me. Sorry, I just got a call actually. So what they are saying is, they are saying gross profit margin is however is considerably lower than in the previous year. So you can see the gross profit margin of course is lower. I have given you one of the reasons. Maybe the purchases are costlier. Maybe they may have some obsolete goods, more of obsolete goods. See, what can be the reason for your gross profit declining? The gross profit can only decline if purchases are costly. If
Or
you,
no demand.
excuse me.
No demand.
Yeah, that means no, that is like when your sales is less. Okay, your sales revenue has been high. Like the cost of goods sold. Yeah, one more reason can be revenue being less revenue, costly purchases, or less purchase or less sales. Yeah, that's what less revenue or less sales mean the same. Costly purchases, and we are speaking about cost of sales. So we are not including direct expenses. If it is cost of goods manufactured, you should take direct expense also. Maybe the direct expenses may be high. Maybe manufacturing expenses may be high. But our aim is to find to see cost of sales. The question is about cost of sales. Okay. So these can be reasons, and there can be loss of inventory, like there can be pilferage, there can be some other kind of losses. So they are saying it is a matter of investigation, it seems. Let's see what they're saying. Gross profit
We are
margin.
also expanding.
Yeah. Expansion. How does it relate to?
Sales mix.
No, I don't get this point. How?
Yes, sir. If we are expanding our business, then our costs incur, no, sir.
Yeah, that's what I'm saying. There can be costs, but your cost of sales formula is what? Those costs will not come here. Those costs will be coming under administration, operating, and advertisement and marketing. Okay. Those will be coming after gross profit, na, Meghna.
Okay, sir. Okay, sir.
Are you getting my point?
Yes, sir. Yes.
Yeah, those are different costs. Selling expenses and all come after gross profit. So let's see what they have said. So gross profit margin, however, is considerably lower in the previous year, lower than the previous year, and is only some 70% of the industry average. So when they compared, it is like how much? Can you just tell me how much is the figure? 24.46 by 35.23. How much? Let us. It is very clear that it has not surpassed the industry average. So there is a poor performance, but it is 70% of this, it seems. This suggests either that there has been a change in cost structure of DG, or there has been a change in method of cost allocation between the periods. Maybe for example, as I said you very clearly, there are three methods of inventory valuation, correct? LIFO, FIFO, and APCO, that is average method. So if at all they use LIFO, they show latest purchases. Latest purchases at times may be more costlier than the previous purchases. There is no guarantee. There is no guarantee, because you may ask me a question. No, sir, today we bought tomatoes for 40 rupees. Yesterday it was 30. I'm not saying it's a matter of debate. They are saying it can be a reason. They're not confirmed about it. Why? Because we don't have the actual data, na? So we are just assuming. Okay. Next. So that's what they're saying. Either way, this is a marked change that requires investigation. The company may be in a period of transition as sales have increased by this much over there, and it would appear that new non-current assets have been purchased. As you said, Meghna, some points here we are kind of considering. Company may be in a period of transition. That means they are changing the things, it seems. So when they change the things, what happens? Maybe the sales go down. For example, suppose they have some goods that are not doing well. So now they want to change their way of selling the goods, or they want to bring new goods, or they want to change their way of doing business. So for that, again, they have to incur money. Am I right? They have to spend money, correct or wrong?
Yes, sir.
Yes, sir.
So they are doing some transition, but even though what is happening is they have purchased some new non-current assets and all, but considering all those facts, the cost have been high. That is what I am assuming more of the reason for this gross profit decline. Okay. Next one. Then can anyone tell me this profitability also this year? It has been good. Operating profits in 2009 has been good. It has been better than 2008, and it has even surpassed the industry average. Let's see the reason. The reasons are pretty clear. Here the sales have been very high, correct? And when compared, the reason for the operating profit to be less can be what? All of you, can you tell me what can be the reason for the profit?
Maybe because gross profit is also less.
Yeah, gross profit is less, but this year this profit has been high now. If you see here, it is 4.87. Even though so that's what I said. Gross profit where it is like 24.46, it is less, but here it is high. So the reason can be the costs after the gross profit margin, the fixed cost, that means the administration expenses and all have been less when compared to previous year, correct? How we can say that? Let's see. See, please understand this point very clearly. See, what is this loan note interest? Is it an income or expense?
Expense.
Loan note interest is the income. It's a
Income.
Income, it's a non-operating nature income. So this is 80. So this is higher than previous year or not? That means your investment income is higher or less? Please tell me.
Yes, sir.
Your investment
High.
income is high. That's a good sign. That may be one of the reasons why your net profit, your operating profit or the profit on sales is high. Point number 2, you try to compare just one thing. I would say just do one thing. 465, just all of you just do one thing. 360 plus 15 plus 12, how much this is? Please tell me. 360 plus 15 plus 12.
388, sir.
388. And what about
388.
280 plus 9 plus 10? This is 290 plus 9, 299, correct?
Yes, sir.
So 388 by 11,200 and 299 by 9,750. Can you tell me the ratio?
The 388 by 11.
11,200, yes.
$3.46.
And what about this? 299 by 9,750?
$3.06.
3.06.
3.06. So almost all the expenses have been same, but what we see is the incomes have been high for this current year, which has made the net profit ratio or the profitability ratio to go high. Okay, that is one of the reasons. So because of that, this is on a higher point. So next point, asset turnover. Asset turnover has decreased this year. What do you mean by the decrease in asset turnover? What does it mean? And it has also decreased.
So maybe no new assets and the depreciation will
Yeah.
continue.
The formula for asset turnover very clearly is revenues, okay, net sales or revenues,
Sales by
capital employed. Okay, so the capital, if this ratio has gone down in 2009, the reason can be the numerator should have declined. The numerator should have. Hello.
Sales got decreased, sir.
Yeah, no. Sales in 2008 were this much. Now this is this much. The sales have increased. It has not decreased. But the ratio to decrease, the numerator should decline. The numerator has not declined here. The numerator has in fact increased. But your denominator has increased considerably, na? Correct.
Yes, sir.
Your denominator has increased considerably. If I have to say, you understand one point. 9.7 by 2.3 and 11.2 by 2.9. So let's say this one 3. For 2.3 dollar investment, you are able to generate, let us make it round figure, 10 by 2 and 11 by 3. That means here you are spending $2 getting like $10 of sale, $3, $11 of sale, which is good. Which is good. Very, very simple, na? 10 by 2 is 5. What is
10 by 2, sir.
11 by 3 is how much? How much is 11 by 3? Yes. Hello. I'm asking.
3.66.
3.6, sir.
3 points.
So now can you easily see the difference? With $2, I'm able to generate $10 of sales. With $3, I'm able to generate $11 of sales. So this is better now always. So here what we are seeing is, with a small investment, we are able to generate high revenues. With a higher investment, we are not able to generate the revenues to the magnitude of what here we are able to generate. Fine. So that is the reason why, because the asset turnover has declined. So the company should try their level best to improve efficiency or try to use their capital try to use their capital more efficiently to improve more sales or to generate high revenues. Okay, and let us see some other reasons also. The one more reason can be, here we should see the interest cost. What is that? But we don't have long-term interest cost. Interest on overdraft, that cannot be taken as an advantage. No.
Sir, quick question. Loan note interest, is it not expense?
Sorry. No, no, no. How it is an expense? You are receiving it, na?
Okay, how we are saying it's revenue? Can you explain so briefly?
Sorry.
Loan note, is there any specific meaning, sir? Loan note? It's a promissory note like that?
Loan note is a security.
Okay.
You are
Like a
holding-
promissory note.
Yes, yes, yes. You are having that
So
security.
the
and you
company given, how to know it's given by the company or it's taken to the company?
see, I will explain you. When I saw the data for this question, I was seeing that this is added to the what we say, this 320, na? Just a second. What is your 320 here? 320. What is that? Yeah. This is 2008's net profit before tax. So you're adding 60 to it. Why will you add 60? Because you should get PBIT, correct?
Yes, sir. Yes.
But okay, just a second. Just a second. This can be an expense, na? Sorry. Yeah, this is expense. Sorry, this is after charging this. This is expense here. This is expense. Why this expense? Why? Because you got this 320, na? This is net profit before tax. We want net profit before interest and tax. So we will add the expense, correct?
Yeah. But, sir, for PBIT purpose.
Sorry. I'm extremely sorry. I didn't see the data actually. Sorry. So loan note interest is here. The company has issued loan notes to public to borrow money from them. I think balance sheet we can see that change. Here it is there, na? 10% loan stock. So 60, 600 ka 10% and 800 ka 10%. Yeah.
Yes, sir.
Now it is all right. Yeah. Small correction, all of you. Like loan note interest in this question is a liability that company has issued some notes or issued some bonds to public and taken loan from them, and for that they are paying interest 10%. Okay, so this is what they have given. So we were doing PBIT and that time also I explained you, but I really, maybe I'm just writing many things here, so I'm getting confused. Is really, see how I'm writing here. So this is all right. Here it is, see this interest, you have to add it here. It's a expense. Okay, PBIT. So PBT is given to you, just you have to add. We were discussing something, na? Account receive. Yeah, just a second. Yeah, we were discussing about asset turnover. So asset turnover, what we are seeing here is maybe the capital employed. So capital employed, net revenue by capital employed, debt and equity. So what about what is the status of your equity? And this is the debt. So your debt is like kind of
Debt increased by 200,
yeah,
but there is no change in equity.
Yeah, your debt has increased here, and your debt has increased. That means you'll be paying more interest. Okay, and that will be in turn kind of impacting your numerator. Am I right? Because it is like, but numerator you will know, you will not take, because asset turnover is revenue by capital employed. So numerator it has nothing to do. Only the denominator thing is increasing because your loan has, where is your loan? Your loan note, you have borrowed more this year. Okay. So where will we doing this formula? What is that? So revenue by capital employed. Here you can clearly see in the year 2009, you have taken a higher loan. That means you have increased your loan, okay, from 600 to 800. That can be one of the bigger reasons of your asset turnover going down. Why? Because your investment is high in the 2009 year. Accordingly, your revenue has not increased, it seems. Okay, that can be a reason. So what can company do then? What improvement company can do? If anyone can answer me. What can company do to improve its asset turnover?
So they may
They should try
raise
to borrow less.
funding.
Yeah,
Yeah,
should
they
try
may
to
raise
borrow
funding.
less. Yeah, or they
Yeah.
should try to borrow, like they should try to raise more equity. Then they can try to
Yes, sir.
improve. Yeah.
Yeah, they can reduce the interest.
Yes,
obviously.
yes. No, sir. Interest has nothing to do because numerator we are considering revenue. Only denominator aspect is the issue here because we are not taking profit and anything, na. So where the interest matter is there, we can only say to decrease the denominator. They should decrease their denominator. For that, if the denominator is less and numerator is high, the ratio would be high. For denominator to be less, they should borrow less. They should borrow less. Correct or wrong?
So in that case,
No,
sir,
in
if
that case,
they,
in that case, equity can be high. I understand. In that case,
Yeah.
equity can be high. The only reason to increase their asset turnover is nothing but to increase their revenues to a very high extent comparatively. Okay.
Yes, sir.
So if at all I borrow 100 rupees, my capital employed is 100, and this year my capital employed is like 100, my sales were like 1000, my sales are 1200, then this would be a better year. But they should try their level best not to increase this and try to increase this more and more. With less amount, more sales. That shows more efficiency. The next point, then other things are pretty clear because this discussed, this discussed, this discussed, this one. Current ratio is fairly good here, better than industry average. The liquidity is high. Quick ratio is less. That means their quick ratio is less, but better than industry average. So what does it mean? Okay, fairly good. We can adjust with this company. Gross profit margin we have discussed. Account receivable, fine, there is no change. Better than industry average. They are taking very less days to collect their money. Here, in fact, they are taking very less time to even pay the money. Better than industry average. They can get good discounts in the future. They can maintain good rapport with their suppliers. Inventory turnover has been less. What do you mean by inventory turnover? How much time it takes for you to convert your inventory into cash? So it is taking 13.2. This is very less, na? Correct or wrong?
Yes,
Yes,
sir.
sir.
sir,
Yes.
So what do you mean by this? See, inventory turnover of 10 or 12, which is good. What do you mean by 10? 10 times? What do you,
Better, sir.
yeah, like 10 times, let us see, let us divide by 360 and get the answer. 360 by 10 is how much? 36 days it takes for you to convert your inventory into cash. Here, let us take 360 by 14, 360 by 13, 360 by 18. Can you tell me in terms of days, what are you getting here? We'll get the answer. 360 by 14 is how much?
25.7, sir.
25.7.
So it takes 25.7 days. Here,
27.69.
so it is taking more days for them to convert inventory into cash now, but okay. But it is better than industry average. And here industry is
20
doing-
days.
Yeah, so in
20
industry,
days.
when compared to industry, these people are performing less. They should try their level best to market and improve their advertising skills, etc., to improve the sales. Last but not the least is gearing. So what about gearing? Here their debt to equity is their debt. Hello, are you following? Yeah. Their
Yes, sir.
debt,
Yes, sir.
here their debt in the total capital, that is debt plus equity, happens to be a more thing, correct? Why? Because we already know that they have borrowed more, correct? Yes.
Yes, sir.
Yeah.
Yes, sir.
So they should like, but no problem, because 50% debt and 50% equity is all right thing. So they are not doing a crime. They are almost well managed. If they are taking higher risk, then that can also like make them to get higher profits in the future. And they are generating those higher profits here. Why they are generating higher profits? Because they are taking leverage. What leverage? Fixed interest cost, correct?
Yes, sir.
So fixed interest cost is higher. That means what is the benefit of fixed cost? Can anyone tell me? See, fixed cost is always fixed if your revenues are high or revenues are low. If you, even though your revenues are high or low, for example, you are paying 20,000 rent of your premise and you generate 5 lakh revenue. This is a very small sum. What is the advantage here? With this 20,000 rent, it is your wish. You can generate 5 lakhs of revenue, 10 lakhs of revenue, 20 lakhs of revenue, your wish. Now it is upon you how you plan and how you improve your revenues. But if I take variable expenses, with more and more increase in like revenue, your variable expenses will rise. So here you cannot take the advantage. Can you take advantage of variable expenses? No, it is
No,
not
sir.
in your control.
No.
It is uncontrollable thing. So they are taking good advantage of their fixed cost, and that's the reason why we can say they have been profitable, and they are not in danger zone also. They are maintaining a fairly good ratio. Okay. So overall, the report is satisfactory for this company. So this is what we have done, a post-mortem of this question. We have ripped it apart completely and discussed. One small error which has happened is, since you know this these kind of statements in IFRS and all, they don't tell you whether what they are. But I don't know, I missed this line here. This is after charging. So when it is charging, I don't see here any kind of income. Okay, because interest on bank OD is you are paying, and very clearly loan note interest is what they are paying. Why? Because they have borrowed. Where is that? Here the borrowing is very clearly given. Okay, so do a correction of that, and this is like their interest cost. Fine. So this is what about the question, everything I have explained to you. So again, what you should do is, again at home, you should go through this question and also through this complete report. And one homework I am giving to you for today. Tomorrow, I will explain you one more question. I don't know whether I should give you this homework. Why? Because consolidation I have not explained to you. And here they are giving you a consolidated statement of financial position. So leave it. I will explain you this question tomorrow. And one more question I will bring. Okay. This question was given in the paper 2015 June paper. We will discuss this question tomorrow completely. Come on.
Okay, sir.
Okay.
sir.
Thank you, all of you. Bye-bye.
Thank you, sir.
Thank you, sir.
Thank you,
Thank you.
Thank you, sir.
Thank you, sir.
Thank you. Thank you.